Here are some psychological traps for investors and traders. Psychology plays 90% of the role in trading. No matter how good your strategy is, if you're failing at psychological level, then you may not be profitable. Investors and traders often fall into psychological traps that can lead to poor decision making. Here are some of the most common ones. And the very first one is overconfidence bias. Traders believe they are better at predicting markets than actually they are. This leads to excessive trading, taking outsized risks, or ignoring contradictory evidence. Another one is loss aversion, feeling the pain of losses more strongly than the pleasure of gains. Investors may hold onto losing positions too long, hoping to break even rather than cutting their losses. And the third one is herd mentality, copying what the majority is doing, especially during bubbles or crashes. And this one is leading to buying high and selling low, amplifying market trends irrationally. And the fourth one is confirmation bias, seeking out information that supports your existing beliefs while ignoring contrary evidence that challenge their views. So the fifth one is anchoring, relying too heavily on the first piece of information encountered. For example, purchase price. A trader may irrationally cling to a price level, like thinking a stock must go back to what they paid for, which is a psychological trap. Recency bias, overemphasizing recent events or trends while neglecting historical context. And another one is gambler's fallacy, believing that string of losses means a win is due, or vice versa. Markets are not like rolling. Each event is not dependent on the last one. So here is another one, endowment effect, valuing something more simply because you own it. This leads to reluctance to sell underperforming assets. The second last is FOMO, fear of missing out. Jumping into investments because others are making money and you are missing something. This often leads to buying near the top of a trend with poor risk to reward ratio. Last but not the least, disposition effect, selling winning investments too early and holding losers too long, driven by the desire to lock in gains and avoid admitting losses. So here are some of the solutions. Stick to a disciplined strategy with clearly defined rules. Use a stop loss and risk management tools. Keep a trading journal to track decisions and emotions. Actually, there are many free online trading journals that you can use. For example, one of them is Notion. Regularly review and challenge your assumptions. Avoid making big decisions under emotional stress. These were the psychological traps that you need to avoid. So tell me what psychological issues you have while you are trading.